Okay, let's dive right into this explainer. Today, we're cutting through all the internet hype and guru noise to run the actual cold-blooded math on a 20-year financial race. We're putting two absolute heavyweights of wealth building head-to-head: real estate and the stock market.
Picture this. We've got two people living in the same mid-sized growing city. They are starting with the exact same amount of money in the exact same year, 2004, but they're about to make two completely different life choices. One decides to plant roots and buy a house. The other? They decide to rent and dump their cash into index funds.
Fast forward 20 years. We're at a dinner party, and we're asking the uncomfortable question that, let's be honest, nobody ever answers truthfully. Strictly mathematically, who actually won? Not socially, not emotionally, and definitely not in terms of who has the nicer kitchen renovations. With the exact same starting capital and living through the exact same economy, which strategy actually built more wealth?
Let's set the scene back in 2004. You're 32 years old, you've got a stable job, decent credit, and you possess exactly $60,000. And you've got to make a choice that is going to define the next 2 decades of your financial life. What's the move?
Well, path A is real estate. You take that 60 grand and use it as a 20% down payment on a $300,000 home. You lock in a 30-year mortgage for the remaining $240,000 at 5.75%, which, by the way, was a perfectly normal interest rate back then. Your principal and interest payment, it comes out to about $1,400 a month.
But here is the absolutely crucial point. While your base mortgage might be $1,400, when you look at the full picture, the story changes completely. You have to add property taxes, which in most American cities hover around 1 to 1.5%. Then throw in homeowners insurance. And of course, maintenance, which people literally almost always underestimate. The golden rule is usually 1% of the home's value per year, just to keep the place from falling apart. When you add the whole shebang together, your true monthly burden is actually $2,090.
All right, let's jump to 2024 and see how this all played out. Home values in a typical mid-tier American city roughly doubled over that 20-year stretch. So boom, your home's value jumps to $600,000. You decide it's time to sell, but you still have to pay off the remaining $170,000 mortgage balance plus those hefty realtor commissions. After all that friction, you finally walk away with roughly $397,000 in cold, hard cash.
Now, what's really fascinating here is a hidden number. The one the real estate industry definitely isn't putting on billboards. Over those 2 decades, your total out-of-pocket spending, meaning that initial down payment plus every single one of those monthly payments, was actually $562,000. And that was just to get that final payout of $397 grand.
Hold on a second, though. That framing isn't entirely fair, right? Because our alternative path, the index investor, well, they also had to pay for a roof over their head. They couldn't just live for free. And this is exactly where the comparison gets real, and honestly, where the numbers get incredibly fascinating.
Let's look at Path B. Back in 2004, our stock investor drops their 60 grand into a low-cost S&P 500 index fund and just rents a comparable home. Over the 20 years, that renter pays an average of $1,550 a month. Compared to the homeowner's true monthly cost of $2,090, our renter frees up exactly $540 every single month.
Now, what happens if they invest that difference? By taking the initial $60,000 plus diligently investing the extra $540 every month into the S&P 500 at its historical documented annualized return of 10.5%, something incredible happens. That initial lump sum grows to roughly $430,000, and those monthly contributions, they also snowball to about $430,000.
Which brings us to a genuinely jaw-dropping reveal. Against the homeowner's net $397,000, the stock investor's total portfolio balloons to roughly $860,000. Just on pure numbers, the disciplined stock investor wins by an absolute landslide.
But wait, stop. Before you close out of this explainer and start frantically moving all your money around, take a breath. Because this is exactly where pure theoretical math completely falls apart in the messy, human, real world. You see, both of these arguments usually ignore one absolutely vital factor: human behavior.
The stock investor's numbers? They look perfectly clean on a spreadsheet, but they assume you never panic sold during the terrifying 2008 crash when your portfolio dropped 40% and talking heads were screaming that the financial system was over. They assume you never touched the money when you lost a job in 2012 or when you suddenly really wanted to redecorate your apartment in 2018. The fatal flaw here is that this math assumes literally flawless human discipline for 20 solid years.
The homeowner simply didn't have that option.
For a massive chunk of middle-class earners, the 30-year mortgage was actually the best savings vehicle they ever had, simply because the bank made savings psychologically non-optional. I mean, if you stop paying, the bank takes the house. It's basically forced savings dressed up as a massive liability.
There's also another critical layer to the homeowner's advantage, and it comes down to a powerful economic concept: leverage. This is a massive piece of the puzzle for how everyday people build substantial equity over time. Think about it. The homeowner bought a massive $300,000 asset using only a fraction of the cost. That is a 5-to-1 leverage ratio. So when the house doubled in value, they captured the gain on the entire asset, not just their down payment. The stock investor, they were only working dollar for dollar. But, and this is a big but, leverage is a double-edged sword. It amplifies losses just as intensely. Back in 2009, over-leveraged homeowners didn't just lose their down payment, they lost everything, and sometimes still owed money, whereas the stock investor could have just gritted their teeth and ridden out the crash. So the homeowner wins in psychological durability, while the disciplined investor wins on pure returns. The ultimate winner, behavior over asset class. Because mathematically, the real victor isn't the asset itself, but whichever version of you is more likely to actually stick to the plan without self-sabotage.
But here's where we zoom out, and honestly, the story gets a bit unsettling. We've been analyzing a very specific 20-year window. If you ran the exact same experiment starting today, you'd be operating in a radically different world. Today, we're looking at extreme price-to-rent ratios, completely stretched stock valuations, and mortgage rates hovering dangerously near 7%. Because of these new interest rates, that exact same median house, it no longer costs $1,400 a month. Oh no, the monthly burden is now closer to $3,000. So that forced savings advantage of a mortgage now comes with a significantly heavier and sometimes completely crippling monthly cost. You see, both the real estate and stock market arguments rely heavily on a deeply ingrained assumption that assets just always go up. But that assumption was built on a really unique historical period. We're talking constant population growth, an era of wildly cheap energy, unprecedented expansion of credit, and decades of relatively stable politics. Those are massive, massive macro tailwinds.
Which leads us to the big question, the one nobody running a finance channel really wants to ask. If these historical tailwinds aren't guaranteed moving forward, what happens to the highly disciplined investor and the responsible homeowner over the next 20 years, even if they do absolutely everything right? What if the math simply doesn't work out the same way?
The unsettling truth, the one that leaves us all sort of questioning what we truly know about wealth building, is this. We do not know what the next 20 years hold. Honestly, we never did. Perhaps we were all just living through a long, remarkable run of luck and confidently calling it strategy. Think about that as you chart your own financial course. Thanks for joining me on this explainer.